Hello, this is Dr. Liddy Louie, and I want to thank you for taking a few moments today to give me the opportunity to talk to you about living benefits, which are the new type of life insurance policies that have been in place in the United States for the past years. And if you're wondering why you've never heard about living benefits, is because the insurance industry has done a very good job of not marketing and not telling new customers or old customers about the importance of living benefits policies. So we're going to correct that miseducation or misinformation today. A little bit about myself before we begin. I am a finance professor and law professor. I've been a professor for the past 10 years at the graduate level. I am a former New York State Assistant Attorney General, cleaning up Wall Street, making sure that they do right by consumers. And we know that is always a challenge. I have a few degrees and popping up on the screen. And I've worked on Wall Street for over 23 years, regulating them on on the regulatory side. And I am licensed by several states, both as a lawyer, also as a life insurance agent that focuses on retirement growth and investments. And I do research on what we're about to talk about this evening. And that is, how can we use our life insurance policies to do more for us the way the wealthy use it? Let's bring those strategies to us in the middle class. So, what is living benefits? Well, the story of living benefits is that it started in the late 60s by two brothers, also happened to be two doctors, Dr. Marius and Christian Barnard. They did the first human to human heart transplant. And when they did, revolutionized science, they revolutionized medicine, and they revolutionized the financial industry because the people that they operated on and lived beyond what all of the actuarial tables, all the math said that they would live. Unfortunately, those individuals were not prepared to live beyond beyond the operation. They could not go back to work because they were too ill. They still have a lot of expenses, both healthcare and just living, rent, mortgage, food, and they had no money. The two brothers, the two doctors, contacted the UK insurance carriers and said, do something, that all of these people have life insurance policies. What can we do to get these people some money? They are dying because they don't have money to be able to live. And the insurance carriers responded. And they created what we call today living benefits policies, which is the ability to accelerate to you a large portion, in our case, up to 90% of the face amount of the policy, of your life insurance policy, when you become ill and you can't go to work for an extended period of time. And we'll talk about what those specifics are. Certainly, heart attack is included, stroke is included, a diagnosis of cancer is included. We have several things that are included that would allow you to accelerate upfront to you to be able to use the money in your life insurance policy. So this living benefits policies did fabulously in the UK and the EU. People bought these policies because they recognized the importance of having it in their lives. And today, if you try to get a loan of any type in the European Union, you must have a living benefits policy for them to be willing to give you any sort of commercial or private loan. In the US, we've had living benefits since 1998, and we've heard nothing about living benefits policies. The Japanese heard about it around the same time, and 25%, one in four Japanese households have a living benefits policy. For us, the number is much different. Only about 2% of all life insurance policy holders have living benefits policies. There's 149 million life insurance policies in place in the US, and only 150,000 are living benefits policies. Well, why is that? Well, the reason is the insurance carriers don't want you to know about it. It costs them too much money to provide a living benefits policy to you. Here's why. You're looking at 3 pages from a claims report that a major insurance carrier published when they did a study on how much money are they paying on benefits. They realized within a 5 year period, they paid out $2 billion in living benefits. These individuals had one thing in common: they all got sick, none of them died, and they all got paid out on their living benefits policies. For the men, this is on the far left column. There are three main killers of our men: heart attack, cancer, and stroke. Is 80% of all the claims that men submitted. For our women, we've got one killer: cancer. 77% of all the claims filed by the women was because of some form of cancer. Here are the age breakdowns. We women tend to get cancer as early as 18, and the highest concentration goes all the way up into the time that we're 50. That is the from 18 to 50 is when we're most likely to get a diagnosis of cancer of some sort. For our men, it's just the reverse. Our men tend to get sick when they're older. So starting from 40 all the way up into the 70s is when our men are likely to have a heart attack, cancer, or stroke. This is why life insurance policy is more expensive for men when they get older than for women. So, who are the carriers that we work with that do provide living benefits policies? We only work with life insurance companies that are committed to providing living benefits policies. Well, we work with 9 such companies. AIG, American International Group, is by far the largest US based insurance carrier. We work with AIG to provide these types of policies. We work with National Life, we work with Fidelity Guarantee, we work with United Farm Family, we work with Life Insurance Company of the Southwest, American National, as well as American General. And all these carriers have one thing in common: they provide living benefits policies, not only to the middle class, but primarily to the wealthy. These are the carriers that the wealthy, that the Forbes 400 richest people use. They all have living benefits. The celebrities that we love to watch their movies and listen to their songs all have living benefits policies in case something goes wrong with their bodies. Their bodies are insured to provide them with money for them to continue to live. So, why is this so critical? Why are we having this conversation today? Well, the numbers don't lie. And on average, a living benefits policy is on the carrier's books, i.e., it's owned by the policyholder, that would be us, for only 8 years before the policyholder needs because they got ill. Only 8 years. That is how tight the span is between when you get the policy and when you are likely to need to use that policy. Harvard Law School did a study a few years ago, determined that 60% of all bankruptcies in the United States was due to one thing: medical incapacitation, which is people got ill and could not go back to work anymore, and they had to file for bankruptcy because they had no money. The average age of bankruptcy in the United States is 43, which means we are getting sick in our 40s and beyond. That is when we need to have these policies in place. So, what happens when you do have a medical event that triggers these policies? Well, you can pull down to you up to 90% of the face amount of the policy. Let's be very clear: this is not at about 30 or 40% of your paycheck. We're talking about 90% of the face amount of your policy. So that means if you have a life insurance policy that's $400,000, think of getting somewhere around $360,000 in one check within 8 weeks of a diagnosis. Aflac can't do that for you. and never will. This is different. And if you have $1 million policy, look to have somewhere around $900,000 in one lump sum check being deposited into your checking account. The first ever documentary on living benefits was done a few years ago. It aired on Fox News, then it aired on CNN, then it aired on PBS, and then we never heard of that documentary again. The kibosh, it became very quiet after that in terms of the marketing efforts to get the word out. One of the individuals that was interviewed by in the documentary is one of our clients, Dr. Jonathan, who's a cardiologist up in the Boston area, and he purchased an asset-based policy, and we'll talk about what that is in a little bit. But he was focused on retirement, saving money for retirement. He's a doctor. He spent as much as he made, just about. His wife was really pushing him to look towards the future and begin putting away some money for them. And so he purchased an asset-based policy, and he committed to putting into that policy about $2,000 a month because he was kind of behind. He was well into his 50s before he started saving for retirement. The policy got put in force, and 30 days after the policy got put in force, he had made one monthly payment, and he got diagnosed with throat cancer in a routine annual checkup. And he called to cancel the policy because he needed to focus on saving his life. He could no longer on retirement savings because he didn't know if he would make it. And the agent told him no, he's not going to cancel the policy. And the agent said, I'm not canceling the policy because you are entitled to some money because you got diagnosed with throat cancer. And Dr. Jonathan, being a very smart man, said to him, listen, I'm not stupid. I know how life insurance works. You need to be dead. I am not dead. I'm fighting for my life, but I'm not dead. And he said, you'll never get another payment out of me, and hung up the phone. Well, the insurance agent went ahead and contacted the carrier. They worked with Dr. Jonathan's doctors, and they got Dr. Jonathan a check for $735,000 deposited into his checking account within 8 days. That is the power of what living benefits can do for you. And Dr. Jonathan was extremely grateful. He called the agent to thank him because he didn't realize how expensive it is to fight cancer. And he said it would take every penny that he had. And he didn't think he could get all the treatment that he needed, that this money was a life saving thing for him. And he thanked the agent very much. And Dr. Jonathan committed to spreading the news about the importance of having a living benefits policy. And today he's cancer free, he's back at work, and he does these educational presentations like we're doing today to educate the American public about the importance of getting a living benefits policy. So now you know what living benefits is. Let's talk about the 3 ways that you can have it. You could have it as a term policy, and most people are familiar. It's only for a specific period of time. We call it term, like your car insurance. If you need to use it, it's there. If you don't need to use it, it's an expense that you paid, and it's gone. And you need to re-up, renew that policy every 15, 10, 20 years, depending on how long the term is. Let's look at this comparison chart. AIG prides itself in having very affordable terms with living benefits. And for a $1 million policy for a 40-year-old male who's in fairly good health and he's not a smoker, AIG is comparing itself to what the other carriers would price this policy out for. So here it is in the blue. AIG compares this policy or prices it at $58.39 for a $1 million policy for a 40-year-old male who's in decent health. All the other carriers, well-known names, Mutual of Omaha, Prudential, Transamerica, are much more expensive. And Primerica should be here at the bottom. They would charge $110 for this policy, almost twice what AIG is charging at only $58.39. So let's talk about the breadth get in terms of coverage. Terminal illness. Every carrier by law must provide you a terminal illness acceleration. That is, if your doctor says you only have 12 months to live, they must allow you to accelerate, pull down to you some portion of that face amount. Usually it's about 30% of the face. We allow up to 90% of the face. That's hundreds of thousands of dollars more than what the other carriers are allowing you to do. We provide critical illness, which is what we talked about before, heart attack, cancer, stroke, and you are allowed to put in a claim to receive that money upon the diagnosis, meaning as soon as the doctor tells you, you're allowed to put in a claim to receive the acceleration and receive that money into your household as soon as possible. We also cover chronic illness. We often think of chronic illness as long-term care or disability. This is an excellent policy as we're aging, excellent policy when our body just naturally begins to break down and we can't do two of the six basic life functions. We can't walk without help. We can't eat without help. We can't bathe ourselves without help. And I can tell you, I was one of those people. I was in my late 30s when I unfortunately, during a routine tennis game, planted my feet incorrectly. I wound up tearing my quadricep muscle from my knee all the way up to my groin area. I was in a wheelchair for 2 years. I could not walk. I needed help to use the bathroom. How embarrassing is that? Every day I needed someone to help me get up and get onto the bathroom seat. I spent every dime I had to again. I was committed to walking, and it took all of my savings. I wished, I prayed that I had had this living benefits policy because I could have triggered it and be able to have had a much, much easier time with my recovery. So it's taken me years to rebuild what I've lost, and I never want that to happen to anyone else when there is a product that we can purchase to be able to protect our bodies. So let's talk about asset-based policies. Also, with living benefits, there are two types that we offer under the living benefits umbrella. The first is called a return of premium. If you come from healthy people where your family tends to live for a very long time and they don't tend to get ill, this is the policy for you. Because once you've been with the carrier for 20 years and you haven't put in a claim, they're going to pay you 50% of the premium that you pay them. If you stay 5 more years without putting a claim because you're healthy, they're going to return all the premium to you. So your life insurance is free. And if you reached a beautiful age of 85 and never put in a claim, where they're going to pay you the face amount of the policy as a thank you for being so healthy. My family does not come from a healthy stock, so this product would never work for us. But I am sure that there are families that are just healthy people and living to a ripe old age is a blessing. Let's have a policy in place that protects that and gives you the kind of money that you need to give you a very wonderful, wonderful retirement. The third type of policy where you can have the living benefits is our index universal life policy. This is the policy that beats Wall Street 100% of the time because there are no losses in this policy ever, and there are no taxes in this policy ever. So I'm a finance professor. Let me tell you a little bit about the stock market that you did not know. Since 1946, there has been a market correction, really a market loss, where people lose their money in the stock market on average, every 6 years in the United States. And it takes 9 years to recover your money when you experience a market loss. So think about this for a moment. On average, every 6 years, there's a market loss. It takes you 9 years to recover. So that means while you're still trying to recover, there's another market loss. This is why the math requires you to continuously to be putting money into your retirement accounts on a monthly, quarterly, or annual basis. It requires that constant stream of money from you to keep it going because it's unable to create that growth for you by itself. So, how are we different? If we know that the stock market is going to have a market loss on average every 6 years, then clearly we should not be in the stock market. And that is what the wealthy do. They are not in the stock market. So let's talk about what we do. We can guarantee no losses and no taxes because of the Internal Revenue Code. Section 7702 of the Internal Revenue Code says that fiduciaries must guarantee that there are no losses in the accounts of the individuals that whose money that they are protecting. Insurance carriers are fiduciaries. Wall Street is not a fiduciary. Money managers are not fiduciaries. They're primarily brokers. You ask them to do something, they put the trade in for you. But they are not your fiduciaries. They are not looking out for your money, charging you a lot of money to do the little that they do. Insurance companies are different. They are required under Internal Revenue Code to look out for you, which means if there's a loss in the market, they absorb it. They cannot pass that loss on to you. That's why you have no losses in your account. And I'm going to demonstrate that for you in an illustration in a few moments. Section 101A of the Internal Revenue Code says that money that you get from an insurance carrier is tax-free. It's not taxed at the federal level, it's not taxed at the state level, it's not taxed at the municipal level. So we are different than Wall Street. And because of that difference, we work with Wall Street to have them create very conservative, proprietary indexes that are tracking Wall Street, but that are not in Wall Street. They're basically buying options on the right to buy stocks at the possible price without any of the losses. We work with Merrill Lynch and they've created a 8.1% annually compounded index for us. We work with Barclays Bank. They've created a 15% annually compounded interest index for us. We work with PIMCO and they've created a 12% annually compounded interest for us. We work with the Dow Jones Commercial Real Estate. They've created an 11% annually compounded interest for us. What does that mean? That means you will no longer suffer any losses on the account because it's not the up and down of the stock market. These are indexes that are tracking and creating for you interest on an annually compounded interest level that you can't get anywhere else. Look at the interest that you get in your checking. It's about less than 1%. It's probably half a percentage point. Here you're getting at a minimum 8% annually compounded. That is how growth and wealth is created. So I want to do a couple of comparisons for you because I want you to understand the power of how this works. So the first comparison I'm going to do is your traditional sort of retirement investment account. So these are Wall Street tools that we're using, and I'm going to explain everything that we're doing so you know how this works. On average, when we retire, most people have, or the average amount of folks have, $400,000 in their retirement nest egg. Some have more, some have less, but the average is $400,000. So we've put in $400,000. Then we've put in the rate of return, and this is actually Wall Street's rate of return for the past 20 years has been 5.2%. And I'm going to prove that to you in just about 1 minute in another Wall Street tool that we have. 2% is the average of the fees. Remember, Wall Street doesn't do this for free. Your 401k, your 457b, your mutual funds, your IRAs, there is a fee. A management fee. They call it assets under management that they're charging you. It ranges from 1% to about 4%. We've taken the middle, which is 2%, is probably less than the middle, to demonstrate the power of what we can do for you. The current age, we've discovered in terms of studies that when people begin to really focus on retirement is 43. That's a lot later than they should, but that is where we are at in the United States, and that's the number that we're going to use. 67 has become the age where most people are now retiring. It's no longer 62 or 65. Some are retiring even as late as 69, but we're going to take 67. So it's 24 years investing that you're doing. And what is the accumulation when you add in all these percentage increases? It comes out to a little over $500,000, 553,000 that you're going to have in your nest egg. And we talk about taxes. I know folks don't like it, but remember, if you're participating in your company's retirement plan, then you are saving on the taxes, and you're going to have to pay them on the back end when you start taking money out of the account. So let's look at how long your money will last in retirement. So if you have on average $553,746 when you retire in your retirement plan, and let's say you retire at age 67, and you will have a lower tax break at that point. It's usually about 25% rather than the 33 or 39% you were paying when you were working. So we put in 25%. And I'm going to say, how much of this money do you need to live on an annual basis? And I'm going to say you need about 10%. That's only $55,000 a year that you're going to be able to pull down every year to be able to live, because you're no longer working, you're in retirement. So how long will your money last when you are pulling down 55,000 every year from your retirement nest egg? Well, here it is. If you retire at 67, starting at age 68, you pull out $55,000 every year, and you are out of money at age 77. There's nothing here. There's nothing after age 77. So your money only lasted you a very few years. It only lasted 8 years. This is why so many people are going back to work at Walmart and Kmart, CVS, Walgreens after they've retired. They've run out of money. And why is that? Well, you never paid the taxes. Remember, this was tax deferred money that your company was providing you. So you've got to pay the taxes. Then you've got to pay fees. You've got to pay distribution fees. You've got to pay management fees. So when you look at the taxes, the fees, and really the withdrawal amount, right? Because you're taking money out, it doesn't last very long. You are out of money in 8 years. And you might say, okay, well, you don't need 10% to be able to live. You don't need 55,000. You can do it for less than that. Okay, let's say it's 8%. So you're living on $44,000. Well, that got you an extra year. And you might say, well, Dr. live on less than that in retirement. Okay, let's drop it to 7% then. So you picked up till 80. You're living on $38,000 a year, and your money will last you until the age of 80. That is the reality of where so many Americans are. But with us, we use different tools. We are not in Wall Street. We use tools, and that'll be module 2 when we spend a little time looking at these tools that we use. What if you were the same $400,000 investment placed into one of our products? And let's see how long that would last. And I think 85,000 is a very comfortable amount of money to live on in retirement, $85,000 a year. And let's see what that triggers for us. Well, our $85,000 lasts well age 87, and it says even beyond age 100 that you continue to get $85,000 out of your account every year. So you're going to have to look forward to module 2 to see how those conservative indexes that we have Wall Street designed for us, that 8.1% annually compounded interest creates so much growth. Tune into Module 2 to see that. But if you were to try and pull out $85,000 in your $553,000 nest egg, you'd be out of money at age 72. Whereas you're able with us to continue to live well past 100, pulling out $85,000 a year. I promised you that I would explain to you that Wall Street has only returned 5.2% in the past 20 years. And let me show you the tool that Wall Street uses to do these sort of reverse engineered projections. So if I gave you $100,000 back in 1998 and I said, go forth and prosper, invest in the real estate market, well, you would have done very well that year because that was the age of the dot-com stocks, and you would have made 26,000. You would have made 26%, which would have resulted in an extra $26,000 in the account. And in 1999, the stocks took a little bit of a decrease in terms of the dot coms, but they were still doing okay, and your money would have jumped up to 151,000. And then in 2000, there would have been a 10% loss in the market because everyone finally realized that the dot coms had no value in them, and 10% of the market was lost that year, and you lost a couple of dollars. In 2001 was the 9/11 incident, horrific, terrifying event in New York City. I was there that time, and I can tell you, I thought I would get then, and the market reacted and lost 13% of its value, and you lost some money again. And in 2002, we were in a full-blown recession in the United States, and we lost 23% of the market. So your $100,000 investment, having made you some money, was down to 90,000 in as short as 5-year period. What if we had taken that same $100,000 and put it into one of our indexes? Remember, the index are conservative. They are not in Wall Street. They're options that are mimicking Wall Street. And we have a cap of 13%, meaning we will credit you everything up to 13% in the account. So the first year, we would have given you 13% and your money would have gone up $13,000. And the next year, we credit you 13%. Your money went up to 127,000. The very next year, 2001 and 2002, 3 years in a row, when the market was losing money, you got credited a zero. No losses, no negative. You just stood still. This is where the concept of zero is your hero comes from. We do not pass the losses on to you. You just hold on to your money. From 2003 through 2007, the market went up and down, and you actually got back up to 151, which is where you started in 1999. What did I tell you? That it takes you about 9 years to recover your money when there's a loss. So let's count. So 1, 2, 3, 4, 5, 6, 7, 8, 9, like clockwork. 9 years, you're right back where you started. So there's been no real growth. It's just replacing what you had lost. And don't forget, you've also paid money management fees to the house that's managing your money. You don't get any of those fees back. So in 2007, let's look at where you are. You're right back at 151, where you were 9 years previously, but with us, you're at 189,000. So there's been some marvelous growth in your account, and you've never had a headache day. You never worried about the stock market. In 2008 was the horrible real estate debacle on Wall Street. We lost 38% of the value, and your money was down to $93,000. And you got credited a zero with us. No loss whatsoever. Your money just stood still. Where everybody else had lost so much money, look at the difference. You're at 189,000 versus 93,000. You're almost at $100,000 increase above Wall Street. Why? You never had a loss. From 2009 to 2017, the market did okay with a little bit of loss. 2015 that most people didn't even notice. So where are we at 2017, last year, how did the account do? Well, you had $275,485 in your account. And how about us? If you were with us, how much money do you have? Well, you have $425,176. That is a difference of about $150,000. That is 154% more than Wall Street. But it's better because this money, this 275 hasn't been taxed yet. Remember, this is all qualified money. This is all of your money that is sitting in your retirement fund, which is tax deferred. The taxes of about 33% have to be taken out of this money. So that's roughly going to be about 68 to 70,000. So really you have 205,000 $485 that you could really use versus the 425 176 where there are no taxes on this money whatsoever. It is all yours. That is the difference between us and Wall Street. So we've looked at how long your money will last in retirement. On average, it's about 8 years. 8 to 9 years, and then you're out of money in retirement. And we've looked at the real rate of return of Wall Street, which is only 5.2%, where we have indexes at a minimum that are giving you 8.1% and above with no losses. So, what are the next steps? We want to replace your old life insurance policy. It makes no sense to keep it. There's no living benefits in there in case when you get ill to be able to accelerate and pull that down to you. And it doesn't grow for you whatsoever. You're losing money, real value. Your hard earned money is not growing for you because you've put it in the wrong place. But you have a choice. For the living benefits, you can have it as a term. You can have it as a return of premium, or you can have it as an asset based account that is growing money for your retirement. We want to custom design your life insurance policy. It's not one size fits all. You have different responsibilities to the family, to yourself, and you have a different vision of what your retirement will look like. We work with you and your family to ensure that we meet that vision so you can be financially independent, you can be worry free of any illness, and you can live comfortably knowing that you've done the very best that you could for yourself and your family. So please remember our commitment to you. We certainly look forward to providing many years of service to you and your family. We will custom design a policy that works and makes sense for you. And we believe that your future is in front of you and you should enjoy it with all of the wealth, grace, and gratitude that we all have. So, with that, I want to say thank you. My contact information is appearing at on the slide, but please also reach out to the person that sent you this recording. They will work with me for us to get you the best possible living benefits life insurance policy that works for you. Enjoy your day.